Welcome back to another explainer. So today, we're taking a topic you're probably already pretty familiar with, income tax, and we are completely leveling up our strategy. We're going to take what usually feels like dry, anxiety-inducing math and turn it into an empowering toolkit for your financial literacy. Because let's be real, understanding exactly where your hard-earned money goes and precisely how the government calculates its share, that's absolutely crucial. By the end of this, you're going to have a much sharper framework to take control of your financial narrative and ultimately maximize your wealth.
Okay, let's dive into this. Our roadmap today covers 5 key stops. We'll start with the 3 big taxes, then we're decoding taxable income, moving on to marginal tax brackets, the actual filing process, and we'll wrap up with the best part, tax saving strategies.
So, Section 1, the 3 big taxes. It's time to know your tax types.
There are 3 primary taxes that almost all of us are going to consistently interact with over our lifetimes. First up is your standard income tax that's applied to the money you make from, actually working. Second is the payroll tax, which specifically funds social programs like Medicare and Social Security. And third is capital gains tax. Knowing exactly what you owe and which bucket it falls into is literally step 1 to financial empowerment. You just can't optimize what you don't fully understand, right? Now, what's really interesting here is capital gains tax, because this one frequently trips people up, even seasoned investors. See, this isn't a tax on the money you earn from clocking in at a job or getting your standard salary. Instead, this is the tax applied specifically to the profit you make when you sell an asset or an investment. For example, if you buy a stock and later sell it for a higher price, that profit, the gain itself, is what gets taxed here. It's a completely different lane of taxation, and recognizing that distinction is super vital as you actively build out your portfolio. Moving right along to Section 2, decoding taxable income. Let's talk about the portion of your gross income. All right, here is a massive revelation for a lot of people. Your taxable income is actually not everything you earn. If your salary is, say, 100 grand, you are almost never taxed on that entire figure. Actually, taxable income is just a specific, reduced portion of your total gross income, and this smaller number forms the mathematical foundation for your tax bill. The entire goal of strategic tax planning is legally making this specific number as small as humanly possible. And this brilliantly illustrates how we actually shrink that number down. We're looking at the crucial showdown between a tax deduction and a tax credit. Guys, this is one of the most important distinctions in all of personal finance. A tax deduction shrinks the pile of money the government is allowed to even look at. So a $1,000 deduction lowers the total income they can apply a tax to. But a tax credit lowers your actual bill, dollar for dollar. If you calculate that you owe $1,000 in taxes, a $100 credit means you now only owe $900. Both are amazing tools for sure, but they work in fundamentally different ways to save you cash. Okay, Section 3. Marginal tax brackets. Let's really understand these tax rates. Now, we are tackling the absolute most misunderstood concept in taxes. There is this pervasive myth out there, and I guarantee you've heard it. Someone will say, "Oh, I don't want that raise, because it'll bump me into a higher tax bracket and I'll end up taking home less money." No way. That is mathematically impossible under our system. Moving into a higher tax bracket does not mean all of your income is suddenly taxed at that new, higher rate. Think of it like buckets. As you earn money, you fill up one tax bucket. When that one's full, the extra money spills over into the next bucket. You only pay the higher tax rate on the spillover, never on the water that's already securely sitting in that first bucket. Think about it like this. Sequential chunks of your income are taxed progressively. The very first chunk of your money is taxed at a low rate. Once you've earned enough to fill up that first chunk, your next dollars flow into the second chunk, which is taxed at a slightly higher rate. And then your income spills into the third chunk, and so on. Yes, the weight goes up progressively as your income scales, but the higher rate only applies to that specific top layer of income. Remember, you never lose money by earning more money, period. Let's put that into perspective. If your top bracket is 22%, it literally just means that the last few dollars you earned for the year were taxed at 22%. The vast majority of your income below that threshold, that was taxed at much lower percentages, like 10 or 12%. So your effective tax rate, the actual blended percentage of your total income that you paid in taxes, is going to be way lower than that 22% figure. Grasping this reality entirely changes how you view every raise, every bonus, or that new side hustle. Moving on to Section 4. The filing process, the actual logistics of reporting your taxes.
I know, bureaucracy can feel super daunting, but we can break the entire filing process down into 3 simple, actionable steps. First, you gather your forms, so pulling your W-2s or 1099s from employers, side gigs, or brokerages. Second, choose your filing option. Maybe that's utilizing specialized software yourself, or maybe it's hiring a dedicated professional. And third, meet the deadline. By turning what feels like this big, looming obligation into a simple, highly manageable checklist, you completely strip away the anxiety. So the crucial point in all of this is really just execution. You can understand all the math and strategy in the world, but if you don't handle the necessary forms, pick the right filing option for your specific complexity level, and actually hit those strict deadlines, you're going to end up facing unnecessary friction. Hitting these deadlines is exactly what keeps you compliant and entirely penalty-free. It's really just about being organized and executing the plan.
And finally, Section 5, the best part: smart tax-saving strategies to help you keep your money.
All right, here are the 3 core tax-saving strategies. Number 1, maximize your deductions to shrink that taxable income base we talked about. Number 2, claim every single tax credit you are legally entitled to. And number 3, utilize your retirement accounts. These 3 strategies represent the big transition from just passively paying your taxes to actively managing and accelerating your wealth. This is exactly where proactive, intentional planning pays off big time.
Seriously, retirement accounts are the ultimate win-win. They are specially designated accounts that offer distinct, massive tax advantages created by the government specifically to incentivize you to save for your future. Whether it's completely shielding your money from taxes today or allowing it to grow entirely tax-free for tomorrow, leveraging these accounts is a highly effective strategy. You lower your taxable income right now while simultaneously building lasting wealth for the future.
Which brings us to our final thought. Are you leaving money on the table this tax season? Well, now that you understand how taxable income works, the actual magic of tax credits, and the reality of the bucket system for marginal brackets, you hold the power. I want you to leave this explainer feeling curious, maybe even a little excited, to review your own finances. Take these fundamentals, apply them to your own life, and make sure every single one of your hard-earned dollars is working for you. Thanks so much for joining me today, and keep learning.